Welcome to the Investor Agent Podcast. I'm Steve Seymour, your host, where we help transform the human mindset from scarcity and lack to abundance and wealth, one conversation at a time. Steve Seymour here with the Investor Agents Podcast. Today we have Carl Fischer from CamaPlan on. Carl, thanks for being on our show today.
Hey, my pleasure. It's good to be up here in such nice weather.
Yeah, since you were just down in Florida, right?
Yep, it's actually nicer up here than it is in Florida today.
Was it?
Yeah.
Was it raining down there? Or?
It's raining down there, but I call this free air conditioning.
Getting hot already.
Yeah.
Well, thanks for being on today. So, Carl, you have CamaPlan as your business, and you have a ton of investing experience. So we are very grateful to have the wisdom of Carl on the show today. And my goal is to extrapolate as much information out so that you guys can gain some knowledge and wisdom around investing in real estate or potentially, more so tax-free passive income with qualified plans.
Exactly. I love the tax-free. I'm biased towards the tax-free versus the tax-deferred. So fire away. So
I'll start with the question. Carl, what is the largest expense that most people incur in their lifetime?
If you really look at it, it's taxes. And, a lot of people say it's their ex-wife, the divorce or their home. But when you really look at it, because there's a lot of insidious taxes too.
Yeah.
But when you look at income tax and state and federal tax and city tax in a lot of places, it eats into your income pretty quick.
So did that have an impact on your interest and, focus of becoming an expert in tax-free passive income?
Yeah, of course it did, because, when I graduated, college and I got my first job, launching rockets down at Kennedy Space Center, and they told me how much I was going to make. And then when I got my paycheck, I said, "What's this?" And they said, "Oh, well, that's your Social Security, your Medicare."
Where's the rest of it?
Yeah, right. So that's what I said. I've got to do something about this.
And it's a big thing, for agents and really anyone listening. A lot of our listeners are realtors, and they're not maximizing their tax benefits as agents. Or, really any entrepreneur out there. So, can you tell us a little bit more about CamaPlan, what you guys do, and then I'd like to dive into some strategy.
Sure. CamaPlan was started by myself and my sister, right, back in 2003. And what we learned was our father and mother were in real estate, and their moms and dads were in real estate. So we're really a third generation, and our kids are doing some real estate. So what we learned is if we bought real estate using an IRA or a tax-deferred plan, a 401k, especially in the Roth, that all of our income was either tax-deferred or tax-free, and even the sale of the property is tax-deferred or tax-free till you take the money out. So that was just a good way of increasing your net worth when you had the opportunity to use your knowledge and your expertise, because I tried to do the stock market and I'm not very good in it. I've bought software, et cetera, with it. But now I help people that want to invest in things that they do. So self-directed IRA lets you invest in more than stocks, bonds, and municipal funds.
And CamaPlan is are the qualified intermediary, or
now you're talking 1031.
Qualified plan, is it a TPA?
Well, we're an administrator for the IRAs and solo 401ks, et cetera. And from a realtor standpoint, I love for them to get into the SEP IRAs or the solo 401ks, those that aren't W-2s. But, get a lot of 1099s. So it can work both ways.
So what differentiates CamaPlan versus your typical administrator?
If you compare us to Merrill Lynch or Vanguard, what we do is we don't sell any products. What we do is we let the individuals pick what they want to invest in. Do they want to lend money, turn their IRA or 401k into a mini bank, and lend to a real estate developer, or lend to real estate rehabber or just put a mortgage out on a property that somebody else is trying to buy? Or are they going to buy the actual real estate? And a lot of people even invest in syndications.
So it allows someone to truly self-direct their IRA into alternative investments versus just the market.
Yeah, that sounds even better than what I answered.
Well,
yeah.
I mean, it's just how you look at it. Because I think, some listeners may fully understand what CamaPlan does, but I just want to try to clarify that for them.
Yeah.
And, the power in that is that, when you leave your money up to a money manager, most people set it and forget it, which is nice in a sense, as long as it works out. But when you put your retirement in someone else's hands, it's a roll of the dice.
Yeah, I believe everybody's got to take care of themselves first, and I don't think stockbrokers are any different. So I think that when you think you're going to set your retirement, set it and forget it, I don't think that's the way it works. There's two things I think, right, that you have to be active in managing. One of them is your health, and the other one is your finances. You can bring in a lot of people and advisors, et cetera, and doctors for your health, but you have to take charge and make your own decisions.
Yeah, I would have to agree. That's really wise. It's a wise statement. Take care of your health and your wealth.
Yeah.
And with investing, when you hand it over to a broker, I've always been told invest in what you know, and then you're totally kind of giving up control unless you're researching and constantly staying on top of the news and the market. With the self-directed IRA, it allows them to invest in real estate where, I know you can't invest in your own business or your own deals, but when you passively invest in other people's investments, you still have a sense of familiarity, or more. You could potentially have more inner knowledge of what the deal is, right?
Absolutely.
So you get to evaluate it and underwrite the deal just as any investor would.
Yeah, I mean, most realtors are out there and they're seeing people buy real estate, and they can see what happens to that real estate 5 years down the road, 10 years down the road. So, yeah, I think that realtors are in a great position just from what they see and who they talk to invest in real estate.
So let's dive into some strategy and some details, because I know there's a wealth of knowledge in there, and I might not even be asking the right questions. So what questions should someone be asking about self-directed IRA investing?
I think you touched on the one, what do you want to invest in, right? And I think your number one answer, invest in what you know and understand, is, to me, the key. Because if you're doing that, you have less worry, you have a better chance of success, and if you're familiar with it because of your other dealings, you're not scared and you're ready to accept whatever comes your way. Now, when I first started lending money, I thought it was a good opportunity because I couldn't go out and do all the due diligence. But when you lend money, somebody's doing due diligence, and I would always lend on a property where there was good due diligence. And what I looked at was, if this property goes into foreclosure, is it better for me or worse than me if they pay it off? So if it was better for me, if it goes into foreclosure, it was an easy.
Lend them the money.
Lend them the money, right. It was
If you make a mistake, I might make more money, right?
Exactly. And I learned that from somebody who lent me money after my father died.
And that was really just a function of determining how much equity is in the property, right?
Yeah, exactly.
The fair market value or the as-is value, and what the rehab's going to be, if there's any construction loan on there, make sure they don't get ahead of you on the loan.
And I love point lots, with water on two sides of them. Those were always good. And, they hardly ever go down in value, even in recessions. So.
Yeah. And I know you're not, are you technically a financial advisor or no?
I am not.
Right. So we're not giving any financial advice.
No, absolutely
You're not an accountant or a CPA.
Or an attorney. And
so we're not giving any tax advice. We're not giving any legal advice, and we're not giving any financial advice. That's the disclaimer right there.
Yes, it is. I'm glad you brought that up.
But with that said, we're going to talk about some of these things, and there's going to be some concepts that may benefit you, and you can look into them and verify them with your attorney, CPA, or financial
Financial
advisor.
advisor, right.
So
whoever your experts are, bring them in. And that's one of the things CamaPlan does is, hey, we'll do conference calls with people so that your experts can actually ask us the exact questions. We know the court cases, the rulings, the laws, et cetera, with self-directed IRAs, 401ks.
So I'm going to ask a few questions about, when someone's looking at getting into the right plan. I know your website has a ton of resources about what's the right plan for them. So I don't want to dive into that because I think we could talk hours about what's the right plan for them.
As many as they can get into.
And especially but why don't we touch on tax deferred versus tax free, so traditional versus Roth. And
Okay.
What are your thoughts on that? Because I just want to break it down very simply first.
Well, I'm very biased towards tax-free, and there's arguments out there, and you can go online and listen to all the experts, but tax-free just makes my life easier because I don't have to worry about what is my income tax if I sell a property and want to take the money out. Now I'm over 59 and a half, so I can take that money out. If it's in a Roth, I take that money out and I don't pay any taxes. And so I've removed the obstacle of worrying about our taxes going up or down from where I am when I convert money from a traditional to a Roth. I don't get a break when I make a contribution.
So you don't get the initial tax break with the Roth. It's
Right.
after tax dollars, but you get the tax-free growth.
I get all the tax-free growth and I get all the tax-free rent, and I get all the tax-free capital gains.
So if going back to my initial question, if people's largest expense in life is taxes, wouldn't you rather pay taxes on the seed versus the crop, right?
Exactly.
Wouldn't you rather pay taxes now and pay, it's putting in the pain now for the gain later?
Exactly. That's how I look at it, and I think that that's a very good approach, especially if you're going to be making good returns. I mean, you've seen what the inflation has done to real estate in the past year and a half, 2 years, ever since the pandemic, and all that gets captured in your Roth. Now, is there times when it goes down? Yeah, it's definitely cycles like the stock market, but eventually it keeps going up. So I think that's, if you're going to make 10, 15, 20% returns, you want to do that in your Roth.
Absolutely. And maybe there's a combination of making some, traditional contributions as well, right? Depending on
Sure.
your tax structure and what you can and can't do, with your talking through it with your CPA.
Yeah, and the limitations. Yeah, I mean, you can play both games if you want to play the tax game, or if you want to get the deduction this year, make your contribution into traditional, and then as it go, if the value goes down, and this is whether it's in stocks or real estate. But I converted a house that it went down, a couple $100,000, back in 2008. I converted it to a Roth, and then just wrote it back up.
So can you dive into that a little bit? Like you don't have to give exact numbers, but ideas of what you think that might have saved you on the upside on it, because I'm sure that property increased in value significantly.
Well, yeah, I bought it at $350. And it went down to $150 in Florida, and there was a note on it for $75,000. So I paid taxes on $75,000.
So the value of the property dropped, and then
I converted.
You converted that from it was because it was held in a traditional IRA, and you converted it to a Roth IRA,
right,
while the account was low,
while the property values were low,
right.
Yep.
And then what happened with that?
Well, years later it goes up to, I think it went up at $425. So we sold the house at $425, but now it's in a Roth, so there's no taxes. The loan was paid off, and what I did instead of selling is I sold it with seller financing, so I have that note
back in the Roth,
back in the Roth, paying every month.
Fantastic. So that right there is passive tax-free retirement income.
Exactly. And I mean, if you look at the taxes, from 350 to 75, it was, pennies on the dollar. There's a great book called Keep It, which I learned that strategy from, written by Joe Luby.
So what an important thing to just think about if you did hold real estate in a traditional account, and if the values dropped, that might be the time to convert.
Yeah, because
you convert based on the current balance,
exactly,
the valuation,
value of
and they just want an independent third party appraisal.
Yep, and I got 3 just to make sure.
That's so cool. So what a smart way to leverage your knowledge to influence your investments, right?
Yeah, it's even Dave Horn, I think, told me this years ago, where he said you take that lemon and turn it into lemonade.
There you go.
The value goes down, and
shout out to Dave Van Horn. He's his name comes up a lot on this podcast.
No,
maybe not as much as Robert Kiyosaki, but next in line.
Yeah.
So Carl, I got it. Roth IRA is kind of like the Mercedes-Benz.
Roth IRA, Roth 401k. Yep.
So tax free at the end of the
Health savings accounts are my favorite because you get the deduction putting it in, and if you use it for health care on coming out, it's tax free. So you get both sides. That's the only one that I've ever seen like that.
Now, going back to the Roth IRA, what do I do if I am over the income limits?
For making contributions?
Yeah.
There's several ways to do it. The one that most people talk about is the backdoor Roth. And what you do is, if you're already over those limits on your income, you can make a contribution to a traditional IRA. When you make that contribution to the traditional IRA, you're not going to get a deduction because you're over the Roth limits and over the traditional deductible limits. So it's already paid after tax. So if you don't have any other traditionals, you can take that money and convert it to a Roth the next day.
So you can still create it.
Yeah,
it's an extra step.
It's an extra step, but that happened back in 2010, and they never have corrected the books on it.
Because that's what a lot of people say is, well, my financial advisor said I'm above the income limits. I mean, I hear it all the time.
Yeah,
maybe you need a new financial advisor.
Yeah, or just look up, backdoor Roth on Google.
Yeah. Now,
or call our office.
I'm sure this probably is not something you as a third-party administrator, or I keep calling.
That's fine. That's what
I know. That's not, it is a TPA.
Yeah.
Okay. So, you probably aren't, in a position to give people advice, but I don't think there's anything wrong with me asking this question. What about just breaking the rules and contributing to a Roth IRA above the income limits and paying a penalty each year?
They have that rule in there. You pay 6% on the overage, until that is taken.
This is just theoretical, but if someone was to do a backdoor Roth, they're gonna have to pay the taxes, right?
Yeah.
And it's probably, just for conversation's sake, say approximately 30%, maybe.
Yeah, if they're in the 30% bracket.
Let's just say right around that. Versus if they paid the 6%. Now the 6% taxes every year that it's in the IRA overfunded. Right. Correct me if I'm wrong, because this is just a strategy that I was told about, and I want to put it out there because I like to think creatively in how do people juice up their retirement accounts quicker, right?
Yeah.
With staying in the rules. But if you in theory put 100,000 in, and you paid 6% penalty, that's 6,000, and let's say you were able to produce a 12% return, could you then the next year take that 6,000 out, and now that contribution you're not going to continue to pay the penalty, and you would have a $6,000 balance?
Well, if you put $100,000 in,
right,
you overpaid $94,000.
Right, that's what I'm saying. Could you take that back out?
You can take the $6,000 out and
reduce it each year.
And reduce it, and if you do it you can reduce it each year when you pull it out.
So in theory, you could potentially juice up your retirement account that way as well.
Yeah.
And then you would just compare the difference between paying the taxes once versus paying it year after year.
Right. The rule is written because people will over contribute because they make a mistake or they were making money or they did it in the beginning of the year
Right.
and then they didn't make as much money.
Yeah, and I'm not saying you're suggesting this,
Yeah,
but
right.
I'm just saying based on the guidelines and the rules, theoretically. And then, when you see people investing in real estate deals and lending money to other real estate investors, one of the big words that comes up is UBIT. Can you just touch on UBIT and then we'll, maybe go into some other prohibited transactions?
Sure. If you're talking about the IRA pays unrelated business income tax if it borrows money, as an example, or if it goes into a business. Let's say your IRA bought a Rita's Ice franchise or a Midas muffler shop. That's obviously a business. So if your IRA did that, you would be paying unrelated business income tax, which is taxed at the trust tax rate, which goes to 37% after you make $15,000, $12,000 or $15,000.
So it's a high tax.
So it's a high tax. It's, basically the upper tax limit. If you're already in that tax bracket, who cares? It's the same thing then as you having it, but now your money's going into a Roth. The other one with a Roth or traditional IRA, if let's say you're buying a $100,000 property and $50,000 is in your Roth, and you use that, and then you borrow $50,000, you're at a 50% equity, 50% loan to value, right? Now, what that means is 50% of the profit is possibly taxable, right? But you take that 50% of the profit, let's just say you make $10,000 on a $100,000 property. So $5,000 goes into your IRA. Now the other $5,000 gets looked at, what tax is on there. So you take $1,000 off of that because it's an IRA, and you have $4,000 that's taxed, and then you take away 50% of the depreciation on the building, which is attributed to the loan to value side. And, you end up with maybe $2,000 that you're going to pay at tax rates, and in that example, it's going to be 15% on 2,000. So it's still not a big deal, but don't worry about the UBIT. Talk to your accountant. It's a Form 990T. You can look at it and figure that out. And in most cases, it's not a killer.
Now, on the example you just gave, I'm going to kind of restate back some things just to make sure I understood it better, and it might help some listeners.
Great.
Basically, you had a $50,000 IRA balance. You then went and purchased the property for $100,000 using a 50% loan to value, debt on the property, yep. Right? And then is it UBIT or is it the unrelated business finance debt tax? Is that what it's?
It's unrelated debt finance.
That's
income.
Okay. I don't want to mess it up, but I know it's a different term.
But that's part of the UBIT part of it.
So it triggers the UBIT.
Right. There's two UBITs, right? One is if you own a business, then everything that you make is taxed. If you do what you talk about, a loan, then it's UDFI, which is less.
And that's because of the UBIT's because of the activity in the business, and then the other one is because of using leverage,
correct,
to purchase an asset in your IRA that triggers that.
Exactly.
So with that, you were saying don't really worry about that too much because now you're using that leverage to get a bigger investment, and you only pay your investment that you made from your retirement account is not going to be subject to it. It's only the portion of it that's leverage. That's why you said 50% of it. Correct. In that example. And with that, you said that when that happens, now the depreciation kicks back in on a rental property, which if you bought a rental in your Roth IRA, you don't get the depreciation because there's no benefit.
There's no tax.
Right? There's no tax. So you don't get the benefit of that depreciation. So now that benefit of the depreciation kicks back in, and therefore offsetting the tax burden on that, and it's a lower tax than the full UBIT anyway.
Correct.
So really, in essence, that's a really smart strategy that I'm currently using on a property, and I just wanted to kind of break it down for people because, it's a way for you to really juice up your account. Because if you think, oh, well, I can only make a $6,000 contribution. Well, what if you could get, a loan, to leverage out your investment and get a higher asset price in your retirement account growing?
Right. And the other thing is, if it's an amortizing loan, obviously it's going down every year and you're going to be paying less and less taxes. And if you pay that loan off a year before you sell it, then there's no tax when you do sell it. So you get all that.
So as long as there's no debt on the property at the time of the sale.
Yeah, a year before the sale, then it's
and
completely tax-free in the Roth.
It's such a great strategy. So thank you for sharing that. Hopefully you guys can follow all that. I know it was a lot, but if you have more questions, we could break it down, with some Q&A later. So next thing is lending through IRAs. I've seen that as being a very passive, well, I don't want to say very passive, but it is passive. There's still obviously due diligence that needs to be done. And I know you can't give legal advice, but what would you say are some of the biggest things private lenders should be looking for when lending to different, borrowers, whether they be fix and flip or whether they're, buy, rent, rehab, refinance, the BRRRR strategy.
Strategies, yeah. No matter what it is, I think you want to look at the value of the property. Number two, I like to work with people I like. And number three, I think experience.
Why do you like to work with people you like?
Just because it makes life a lot easier. So that's my three main criteria on that. The more experience they have, the more jobs they can show you have. They know where they are. And you've got to look at the economic times. From 2010 or 12 up to almost today, everything is, we've been in a rising market. So a lot of people have a lot of successes, but are they ready to go if, the economy turns and we're into a recession? What do they have? Are they recession proof? Are they going to thrive or just survive?
And just at the very basic level, someone makes the contributions to their account. They find someone who wants to borrow the money.
They can find you for that, right? You can find
me or someone in my office or,
right.
Any real estate meetup, you're going to always have someone that's looking to grow their real estate investment business, and private capital is a big piece of that. So,
one person said there's more people looking for money than handing it out.
Well, that's true.
Yeah.
And so once they identify the borrower, evaluate the property, do your due diligence on the borrower, the property, making sure. The biggest thing that I heard in there is the equity piece and the market, right? So that you're protected, that if something shifts a little bit, it's not too tight and you wouldn't have to take back a property, which you said that initially, but I just...
Yeah, but if you do take it back, are you going to make money?
Yeah.
Even if the value goes down. I mean, if you're lending at 20%, or 80% loan to value, is 70% better.
So if the market pulls back, there's enough spread there that, if you foreclose, you're still going to be ahead.
Right.
Now, what are some of the other things that a lot of people just don't even think about? Because we operate in the realm of like what we know and what we don't know, but then there's this whole other realm of what we don't know that we don't know, which is things they've never even considered. So, you've been in this a lot. You've talked to a lot of real estate investors. What are some things some things that are possible? Because this whole podcast is about transforming the human mindset from scarcity and lack to abundance and wealth. And how that happens is when a new possibility is created for someone that they think, oh my God, I could do that. So what are some things that you would just share to people over the years that they've never even considered?
Well, we talked about taking lemons and turning them into lemonade, right? So if you remember back in 2008 and 2009, people were just walking away from their houses. So you could buy a house, with a subject to mortgage on it. And renters or owners were doing that because if you did that and you made the payments on the house, it would make their credit better. And what that does is that creates a non-recourse loan for your IRA. So a lot of people were, giving people $1,000 to move and then taking over the mortgage and renting the house out. And sometimes they'd rent it out for the mortgage payment, and sometimes they'd have to kick in a little bit from their IRA. So that's one strategy that...
So kind of combining, I call this stacking strategies. You're taking a real estate investing strategy of like subject to,
Yep.
and you're stacking it together by using a vehicle like a Roth IRA to juice up the long-term returns.
Exactly. Yeah. I mean, I love that strategy. The other one I've seen is where there's people with a shortage of money and they go out there and they'll get a good deal on a property. They did this with some new builds, and the new builds, went up, hundreds of thousands of dollars, but they had to put $10,000 down. So what they did was they put $10,000 down on this new property that's going to be built. Let's say it's a $500,000 property, and it goes up to $700,000, but they'll sell half of that $500,000 property contract for $500,000, right? And a guy will do that because in 6 months he's going to get $125,000 if the property went up $250,000, which is what the builder was selling it at. So the one guy's making 25% on it, and the other guy's making 1,000% on it.
So in this example, just for my own knowledge, there's a real estate developer building a new community.
Yep.
They're taking deposits on these new homes, and someone had the foresight to see that these values could potentially go up a lot. So they put the deposit down out of their IRA account, taking title on the contract through their IRA or qualified plan, and then therefore they invested equitable interest in the property. And as the values went up, as the development got built out, they saw an opportunity to sell that property at a higher value, or not sell the property because they don't own it, but sell their interest in the property. And then that essentially was an investment that came back into their qualified account, tax-free, if it was a Roth.
Yep.
Just because that's a really amazing thing that most people probably never would have considered, and that's exactly what I was talking about.
Yeah,
so I appreciate that.
Yeah, it's think about it as buying options.
Yeah,
a lot of times,
So they made the investment by putting a down payment.
Right, and if the market went the other way, and they were expecting to sell them at 500, and it went down to 400, you'd lose your 10 grand.
Right. Well, it's it's just something that most people would never have considered. So I love the creative strategy and the creative thoughts. Do you have any other examples for things like that? So subject to essentially assignment
of the option. I mean, there are other ones where you just do a straight assignment. There's what I call the young and poor with energy are out there finding deals, and then the wealthy, more tired, older generation is looking for those deals. So what'll happen is the bird dog will find a deal, put their Roth money down, 1,000, 5,000, whatever it is, but then they'll just assign that contract.
So essentially wholesale.
Yeah, exactly, the wholesale.
And
property.
What is your take on that because I've heard mixed messages about potential of UBIT or, the crossover between it becoming an investment and active.
Well, for it to have the exemption for the Roth IRA or the traditional IRA or 401k, you can't make it a business. So it needs to be, you should have the intent of holding the property. And I think it was maybe 2012 or maybe it was 2006 and 2007, there was a property and one of our clients bought it, and, they were going to rent it out, and it was a good deal. And then somebody came to them, and I think they spent $300,000. Somebody offered them $450 like 6 weeks afterwards.
Yeah, why?
And they said,
sure.
Yeah, at that point,
we'll take $100,000 back in the account.
Yeah, 150 at that point. So they were, fixing it up to rent it, and so I mean, you have to see what the economy and what the environment's going to give you, and then be ready. Going back to your set it and forget it, I don't believe in that. I think you've got to touch it, and you've got to have your hand on the pulse of the program.
And so we touched on Roth IRAs and some creative real estate investing strategies in that. And you did mention that HSAs are kind of your favorite too. And I know you said it briefly, but can you just talk a little bit more about HSAs and the benefits of those? Because I don't think a lot of, listeners out there have you even considered HSAs?
Well, if you're paying your own health insurance, you should at least look at the health savings accounts. I used them pretty much ever since they came into fruition, probably a decade ago, where the money that you contribute is tax deductible that year. And if you pull that money out for medical reasons, it comes out that year, or 10 years down the road, it comes out tax-free. So that's the only instrument that does that, tax deductible going in and tax-free coming out. And when I first started, the health savings account insurance plans were better than they are today. When Obamacare came in, they weren't, you didn't get quite the benefit of it. But as an example, we looked at a couple things. With traditional insurance, the one person had a heart test, on the treadmill with the dye, et cetera, and her bill was $15,000, and she had to pay a $2,000 copay. When my wife had it done, her bill was $2,000, so she had to pay the $2,000. So it was equal payments for the same test that came out, and I don't know exactly how it works out that way, but that's what we looked at, and it has a maximum out-of-pocket expense.
What are the contribution limits on that?
It depends if you're single or a family, and it's $3,600 or $3,700, 2022 or 2023, and $76 to $78 if you're a family a year. I mean, it's just a good way to build it, and if you're fortunate enough to, how do I say this? Be able to pay your bills outside of it, you can just leave that money in your health savings account and go lend it out and get a return on it, or you can put it into a property and the rent will come into it, or you can put it into a syndication.
It can act as like a self-directed investment account.
Absolutely. You don't have to keep it at the bank making it.
And then let's say you grow it to $1 million and you never need that expense. Then what do you do?
Well, what I do is I have a credit card, and I keep taking all my medical expenses I put on one credit card, and I've been keeping that ever since I've had the HSAs. And you can take that money out anytime you want. So let's say I've got $1 million in there, and I have, $500,000 in medical expenses that I've paid over the past 20 years. At that point, I can say, okay, I want to take $500,000, and I can pull that $500,000 out tax-free and just be able to provide the receipts of the medical expenses and procedures, et cetera, for my wife and myself, because we have
what happens with the HSAs, at a date of death? Are they inheritable?
They're inheritable, but then they're going to be like a traditional IRA to whoever gets them.
Okay, so they kind of convert back to a traditional IRA.
Right.
Okay, so it doesn't remain an HSA for the heir.
No. Once the family dies, that's.
And then on that topic, with a lot of real estate investors, the old saying was defer, 1031, just scale up, and then, defer and then die, right? And then your heirs will get the stepped up basis on the portfolio. Maybe you have some life insurance to pay for the state tax. With a self-directed Roth IRA, what happens to that when someone passes away?
Well, when you have a Roth IRA or a traditional IRA, you have 10 years in most cases. There are some exemptions where it will go longer, but for most people, you have 10 years to use that money. You can take it out, you can take distributions, you can take it all out at one time, or you can milk it all the way to the 10th year. And at that point, the government's going to make you take it out or hit you with a penalty. And when you take that out, now the next year you have it out, it's going to be taxable. You're going to get it out tax-free, but let's say you have $1 million, you pull the $1 million out, and then you invest it in
anything else you do with it's going to be, it's not going to have tax-free growth at that point.
Right.
So
But again, you might be able to take that money out at some point and put it into your own IRAs or your kids' IRAs to help them with it too.
Yeah, it's it's something that I've looked at extensively. I'm 39 and 4-year-old son, and I still look at all that, estate planning stuff now. And it's interesting to see different strategies and takes on things.
It's always changing. Again, you can't set it
right.
and forget it. The laws are supposed to change at the end of 2025 anyway, and they're talking about changing them earlier.
Do you see anything on the horizon where, the Roth IRAs could be at stake? Obviously, you don't have a crystal ball, and we're not going to hold you to it, but have you seen anything that is a little concerning? Or
they've been talking about Roth IRAs ever since they came in 1998, about who can have them and where they are, as far as letting them keep on going. The one thing that I do think, and I mean, in the last 2 years, they were really against the Roth IRAs because Peter Thiel had $1 billion supposedly in his. And even when Mitt Romney ran, he had, a couple $100 million in his IRAs. And they said, well, this isn't what, it's
not what it's designed for.
Right. But a lot of people said, well, let's look at that model and let's see if we can't do it for ourselves, just because those guys were smart and did it. So I would say get your Roth IRAs as soon as you can, because generally what they do is they let it die out. They grandfather it in for what it is. But I think the first thing is they're going to say, hey, there are no more Roth IRAs. And they did do that back in 2019. Trump did it where he moved it to the 10 years. We used to be able to. And my strategy was to have it out
in perpetuity.
Yeah, 100 years. I could, get it to 100 years before it had to be retracted.
Well, I appreciate all your sharing of this information. It's definitely very valuable. If anyone out there is, still like this is complete Greek to them and they have no idea what we're talking about, there's a ton of resources on Carl's website about what's the best plan for you, the breakdowns, the contribution limits. Their staff is great to work with, and they'll answer questions. And it's really, it's about as simple as setting up a bank account.
Yeah, just like any other IRA. I mean, there's no difference between our IRAs, our reporting requirements, et cetera, than Janney or UBS or Vanguard has to do. So go to CamaPlan.com, CAMAPLAN.com. And if you want a consultation, just schedule it there. Talk to our staff. If they don't give you the answers you want, ask them to set up an appointment with me and we'll go over some specifics. But again, remember, we can't give advice, but we will be there. We do a lot of continuing education, so we can direct your attorneys, advisors, CPAs to certain laws and rulings.
So if you want to, set it and forget it and stick your head in the sand and leave your retirement account up to someone else, don't go to Carl. But if you want to take control of where your investments go and your future and your retirement, educate yourself on the different available qualified plans and the benefits of them, and take your retirement into your own hands is what I would say. And thank you, Carl, for being on today. Just really appreciate you sharing everything. And we'll make sure to post Carl's information below. I always like to ask any last closing words of wisdom.
Well, what I like to challenge people with is maybe take half of your money and do it yourself, and then leave half with your financial advisor and see where you are in a year or two. And I always bet on people that are watching their own money, because I don't think anybody watches your money as well as you do.
Yeah, who cares about your retirement?
The most.
All right. Thank you very much.
Thank you, Steve. I appreciate you having us on.
Absolutely. Thank you for tuning in to the Investor Agent Podcast today. We hope you found it valuable. Please tune in weekly at theinvestoragents.com.